We've gone through 3 bubbles, actually, which should have alerted us after the first 2 that maybe something's wrong. We had the Asian financial crisis in 1997, which was a financial bubble, which came from rapid lending to Asia and then a rapid withdrawal of loans from Asia after an exchange rate. The Thai baht, a rather exotic instrument, was devalued, and that created a cascading panic. What went up came down sharply. When it did come down, Alan Greenspan said, we've got to pump up our economy to make sure that there's no downside. And so after helping to create the first bubble, the Federal Reserve went on to help create the second bubble, which was the famous dot-com bubble. In that bubble, interest rates went down sharply. Money was made available to all. Stock market prices soared. Americans thought, gee, this is great and fun. Spending went up. Saving took a big notch down in the last years of the Clinton era. And, of course, that bubble burst in March 2000. It was as weird as can be, you remember, people becoming billionaires by public offerings of companies that didn't even exist. They had to scramble to get a desk in a room so they could have the public offering to make them billionaires in time. And this we thought was normal. Of course, it wasn't normal. The bubble burst. And when the bubble burst, Greenspan did it again for number 3. And it was the third strike, and you're out, Alan. This time, the Fed cut interest rates sharply again, and the bubble didn't go to dot-coms, it didn't go to Asia. It had to find another outlet. This time it was into housing. And so suddenly the housing prices in this country took off like a rocket. And if you looked at a graph, if one was doing that, and there were economists that do that for a living, like Robert Shiller at Yale, who said, this is not right. Pew, just like that. But nobody wants to think, truly. So housing prices went up, and the Fed kept the money supply extremely cheap and expanding rapidly. And, of course, we all understand a little bit better than we did then that it was very profitable to book loans and complicated instruments packaged of mortgages and then packages of mortgages and then CDOs on MBSs and CDO squares and CDO cubed and things that nobody has figured out except they led to a lot of profits in the short term and a complete opaqueness of our financial system and housing prices skyrocketing and no regulation at all. As Greenspan said recently, he's detected a flaw in his beliefs. Indeed. So equity and housing prices increased by $15 trillion over a period of about 6 years. That's a lot of change, ladies, even for a macroeconomist, by the way. That's a lot of money, $15 trillion. Of course, it's all evaporating right now because it went up and it's coming plummeting down. What happened, I think, is important to understand. The easy money made housing mortgages available to all, including many who could not afford it, obviously. That bid up housing prices. That meant high housing values. That meant that the originators and buyers of the mortgages felt secure because even if there were defaults, the underlying asset would be protective. And that meant even more mortgages lent, the Fed shoveling out the money, foreign money pouring in as our households were borrowing to buy their homes, saving rates turning hugely negative, the United States borrowing $700 billion a year, mainly from China, from Asia, every year, and somehow this was supposed to be normal. And it was the philosophy that after 9/11, what should we do as patriotic citizens? We should shop. And so we went out to shop. That was the president's instruction. And the Fed's instruction was, here, take some more money. Buy another house. and they peddled houses on the street corners until everyone had a few. And they didn't understand the most basic point of a bubble, which is that the high demand for housing was the cause of the high prices. And as soon as the lending would slow, those prices would come back down, and what looked safe would then quickly look dangerous. And this started in 2006. When the lending slowed, the housing prices started to come down. When that happened, certain of these investment funds quickly closed shop in 2006. That accelerated the downward spiral even more. And then banks that held these mortgages had to write down increasingly bad debts. When that happens, the bank capital shrinks, because the bank capital is the difference of the value of assets on the books and the value of the liabilities, which are the deposits and the debt that's been borrowed. And as those asset values were reduced, the capital base was reduced as well. In commercial banks, unlike Bear Stearns and the broker-dealers, when the capital goes down by regulatory action, they have to start cutting back their loans, because there's a maximum ratio of bank lending to bank capital. So when the banks started to lose money and write down the mortgages in 2007, they had to pull back dramatically their lending. That accelerated the fall of housing prices more. That accelerated the fall of credit to households. That accelerated the decline of the real economy. And what looked so good on the way up started to be a massive crisis on the way down. What had happened with that overborrowing and then rapid decline of lending would be enough to create a recession. But we went from that to the brink of disaster a month ago. Because when things get bad and when you're playing right at the edge of the cliff, the chances of things going disastrously wrong by passing certain thresholds becomes also much greater. As the capital was shrinking, those highly leveraged entities found it harder and harder to borrow, and their capital base was, in many cases, shrunk to almost nothing or disappearing, which means becoming insolvent. Whether Bear Stearns was outright insolvent or simply unable to borrow because no one could figure out what they were, perhaps we'll never know. But on the weekend before the Monday, September 15, Bear Stearns couldn't find a buyer and entered Monday, September 15, declaring bankruptcy, Chapter 11. When that happened, that's when all hell broke loose in the world economy, because they defaulted on about $600 billion of assets, including money that of their debts or other people's assets, their claims on Lehman, including Lehman paper held by money market accounts. And those money markets, as you know, are supposed to be dollar for dollar par safe value. And when one of them found itself in a massive loss and declared to its investors that that dollar had just become 97 cents, which isn't supposed to happen in a money market fund, that's when the panic broke out around the world. Because suddenly the Vanguards and the Fidelities and the other money market accounts stopped any kind of investment in anything other than treasury bills. They wouldn't lend to banks. They wouldn't lend to General Electric. They wouldn't lend to blue chip companies. The banks wouldn't lend to each other. Liquidity completely froze up. And that could make the difference of a recession and a collapse. And so what we've been witnessing in the last 6 weeks is a mad scramble, not to stop a recession, because they can't do that, but to prevent an outright collapse.